Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Thermo Fisher Scientific stock. This one came in by request down in the comment section of one of my other videos. If you have a request that you would like me to take a look at, just put it down in the comment section. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500, like Thermo Fisher is, I post those on YouTube for free, and the rest I post over on Patreon, which is only $5 a month. And if you join there, you get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And I'll have those links down in the description. There's also a free tier on Patreon now too, and I've been posting a few things when I get time that are just exclusive on the free tier as a little extra. And of course, you get all the normal videos that I post on YouTube. I also have a 25% off affiliate link for Fast Graphs, which you'll see me using here in this analysis. I've been using it for 5 or 6 years now, and it's really good for especially doing earnings-based analysis like Thermo Fisher. It allows you to kind of see some patterns that you might not see if you're just kind of looking at quarterly reports or something like that. As always, this is not individual investing advice. This is just how I analyze stocks. So, Thermo Fisher. What a pretty earnings pattern. So this dark green area are the earnings, historical earnings per share. And basically they've risen, up until 2 years ago, they rose every year except for a very slight decline in 2009, which is basically the Great Recession. And so this type of steady earnings growth is very popular right now with investors. They like to feel confident in the businesses that they're buying, and so they're willing to pay a lot of money for these. It's just a pattern that I've noticed in recent years. You can actually let me zoom out real quick, and you can see it developing, right? So we had 0% interest rates in 2012, and the stock traded at, we'll call it a 12 PE. I'm not even going to pick the bottom, down in the 10s, right? So a 12 to 13 PE through this time period. And for several years, it was between 10 and 15 PE. Earnings growth was growing about the same then as it's been growing in recent years. But now, even today, before, let's just take a peek here. Before we had the pandemic, the market was willing to pay double for those earnings at 26 PE. And now they're still paying 26 or 27 PE. So, and interest rates were 0, and now they're at 5% or something. So, on the surface, you should be able to see that investors are just paying way more than they have historically. Even during this period in 2015, the PE was trading between 15 and 20 pretty steadily. Again, same type of earnings growth that they had before. The other thing that you can see right away is the COVID boom, and then the bust, which has started, which I warned folks about. And so when I do the analysis on this stock, I'm actually there's basically two things I need to know. The two most important things anyway are the current earnings yield, which is the PE inverted, and the historical earnings growth, right? So because we had this weird period here, when I do the earnings growth calculation, I do it pre-COVID. I see what they did from 2015 to 2020 or 2019. And then I assume that if we didn't have COVID, that's kind of how it would have progressed. Now we did have COVID, so earnings jumped, but now we see earnings growth has been negative for 2 years, on track to go negative for 3 years, and to get back right in line with that trend. I would say back in line with that trend plus about 20% inflation. So take this trend, which was maybe 12% growth, I think we'll see. So add some inflation on there, and we'll do 15. Actually, I'll just do it. Let me just do it with my calculator here. So I didn't do it this way in the analysis, but I did do this for several stocks that were actually looked kind of interesting valuation wise. This one didn't, so I didn't do much work on it. But so if we take this $12.35 that they earned in 2019, and we compound that at 15% a year, so their normal 12 plus another little bit for inflation. Should have been 16, but so how many years? We have 1, 2, 3, 4. We're in the 5th year. So extrapolating those earnings out, we would get $21.60 a share. I didn't know what that was going to be. And what do analysts say? $21.70 a share. So you could do that and just kind of roughly estimate, and it doesn't work for each company's a little different, but this one's so steadily earning that they've continued to grow 12% plus inflation during this time when it's all said and done, if earnings kind of end up falling here. So one way to think about that is this decline is basically, if this works out this year, is back to trend. So you wouldn't really need to make any adjustments for the boom and the bust or whatever if you worked all this out starting in 2025. So the boom, the bust will, in theory, in estimate world, be over here. But it was definitely predictable, in terms of at least by late 2021 and early 2022, because a lot of the stimulus started ending. So, and then there's the COVID testing and all that stuff that went along with that, the actual pandemic stuff as well. All right, so that's the setup. Let's get into the valuation. Other than that, it's a great business. I mean, it's perfectly fine. There's nothing like, I have nothing bad to say. It's very straightforward. So 12% earnings growth, 12.1%. Current earnings yield, that's the current, my estimated 10-year growth will be, CAGR will be about 5%, a little over 5%. Current earnings yield is, they did have some debt that I accounted for, so I raised the stock price by, by about 16%. To account for that. And when I do that, the earnings yield is 3.25%. So earnings yield is the PE inverted. So instead of price over earnings, it's earnings over price. And then that's expressed as a percentage. So the way I think about that is, if I bought their whole business and their debt and other obligations for $100, I would earn, if I owned the business, $3.25 on my $100. And that would grow at 12% each year. The $3.25 would. I pull the first year forward, so $3.64 the first year. And then what I want to see is how much money I would collect on my $100 after 10 years. And I would collect about an additional $64.15. So if you put that in a CAGR calculator, start with 100, end with 164 after 10 years, you should get about 5% CAGR. Well, cash yields about this right now. So basically, the way to think about this is it's priced just how you would expect it, in theory, to be priced. But the difference between this and, say, like short-term treasuries, like / cash, is if we have more inflation than we had over the pre-COVID, which is when I did this, when I did the time frame for that earnings growth rate, which I think inflation was under 2% then, slightly. If we have a period where inflation is 3% or 4% going forward, then this number would probably actually increase by 1% or 2%. So because in theory, these guys can pass that inflation on to their customers, and so you're protected from inflation that way because of the quality of the business. Whereas cash is not, or bonds or whatever, is not protected in the same way. So maybe cash really does earn 5%, but inflation is higher and these guys can pass it on. And, assuming the Federal Reserve does its job, eventually interest rates will catch up to, and short-term interest rates will catch up to where inflation is, or a little bit more, which they have right now. But we'll see. There's no guarantee looking out 10 years that will be the case. And I don't like to, you could look at it as at the 10-year bond. I think it's, the government bond's like 4.3% or something, maybe 4.4. I haven't looked at it recently. So you could look at it that way too. Now, what this doesn't protect against is some kind of recession, some type of competition in their industry, any sort of disruption that happens that way. That's an additional risk you take here that you wouldn't take with the cash position. So when you balance it all out, really it depends on, okay, one, you could take portfolio level like view, but you could say, okay, I think the odds of inflation remaining higher over the next decade are more than, a bad recession that takes a long time to like get out of. So if that's the case, then you might be okay paying that much. Now I like to buy with a margin of safety. I want this to be 8%. So, and I consider like 6.5 to be fair value. So if inflation came in at 3.5% a year instead of 2, then this would be 6.5%, and it would be at fair value right now, right? I mean, that's one way to think about it. Assuming that there's no, I think it's going to be hard not to have like a recession at some point, but that could be an assumption that people are willing to make, or just they're willing to balance out other parts of their portfolio or something like this. So, but I want to make more money than that. I want to make more money than that. So I try to buy stocks when they're cheaper and still high quality, and hopefully I can get that 8% plus inflation, plus maybe some mean reversion, and then hold it for quite a while. So that's what I want to be able to do when I buy something. So, but this is valued almost the same as the S&P 500, I would say right now, approximately, maybe a little bit more expensive. And my normal buy price to get that 8% would be $319 a share. That's about 45% lower than it is right now. I wouldn't worry so much about my recession buy price at this point. If it got down to that, if nothing strange was going on and it got down to below 320, I'd probably be a buyer. Just given their history, just kind of depends on what's going on at that exact time. If the world's totally falling apart, I might wait for that lower buy price. But under 319, 320, like that's where I would aim to buy it with a margin of safety. If you just want to get something like this at fair value, I can give you an estimate of that as well. I'm going to say, I'll test a couple here. So 400 might be, you could probably actually pay a little more than that. I'm going to say about 420. Yeah. So about $420 a share would be fair value. And then that margin of safety would be 319, 320. All right, if you found this useful, hit the subscribe button. I do have that Fast Graphs discount down in the comments section. And if you have a stock you'd like me to take a look at and share my thoughts on, just put it down in the comments. I will get it on the board and I'll make a video for you. Later.